Ever wondered how a company can have flat sales but exploding profits? Today, we're diving into the Q3 FY26 earnings review of Gravita India Limited, a masterclass in resilience and margin expansion as they march toward their Vision 2029 goals. The top-line snapshot shows revenue at 1,017 crores, which is a modest 2% year-on-year growth. However, the bottom line is where the magic happens. Profit after tax surged by 25% to nearly 98 crore. This was driven by massive efficiency gains and a successful shift to higher margin products, resulting in a PAT margin of 9.60%, a significant jump of 178 basis points. When we look at the profitability bridge, the numbers tell a story of sanity over vanity. While revenue growth was muted, earnings per share grew over 18% to 13.41 rupees. EBITDA also climbed 13% to over 104 crore, supported by lower finance costs and highly effective hedging strategies. The real engine behind these expanding margins is value-added products, or VAP. Gravita is shifting away from simple commodity-led towards specialized alloys that cushion the business against raw material price volatility. VAP now contributes 46% of the mix, closing in on management's 50% target. Breaking it down by segment, lead remains the undisputed cash cow, accounting for 90% of total revenue at 915 crore. With a solid EBITDA of 23,035 rupees per metric ton, this segment acts as the primary funding engine for the company's diversification into new verticals. Future engines are showing mixed results. Aluminum and plastics saw temporary revenue dips of 33% and 39% respectively. On the bright side, the turnkey segment exploded by 441% quarter-on-quarter, providing a high-margin project injection. Management aims for these non-lead segments to contribute over 30% by 2028. On the balance sheet, Gravita is deleveraging, with liabilities down roughly 16.7% this quarter. They maintain a stable AA- credit rating and are maintaining a target return on invested capital of 25%. Reducing short-term debt is creating dry powder for aggressive future expansion. Operationally, they use a risk shield known as back-to-back hedging. This allows them to lock in 9 to 10% margins regardless of metal price fluctuations. Essentially, Gravita doesn't bet on metal prices, it bets on recycling volumes. Looking ahead to Vision 2029, the roadmap is ambitious: a 25% compounded annual growth in volume and a 35% growth in profitability. They've already spent 125 crore on capex so far in FY26, which is part of a massive 700 crore plus total capacity expansion plan. The government is also acting as an ally through regulatory tailwinds. Tightening battery waste management rules and extended producer responsibility policies are shifting scrap away from informal dealers and toward formal, compliant players like Gravita. However, we must consider the risks. There is a 90% dependency on the lead segment, and diversification is currently slow. The aggressive 700 crore plus capex plan requires timely commissioning, and the company remains exposed to international logistics volatility. Watch these specific areas on the quality checklist. There was a 214 crore inventory buildup in the first 9 months of FY26, which may impact cash conversion. Additionally, there is an ongoing appeal for a 70.10 crore customs demand and a recent accounting transition regarding Ghana. The final verdict is one of resilient consolidation. While revenue growth is currently neutral, profitability is excellent and safety is high due to the AA- rating and hedging. The outlook remains positive as long as Vision 2029 stays intact. If you found this analysis of Gravita's strategic shift helpful, make sure to like, save, and share this video. Follow @ZinvestZ for more smart investing insights. Thank you.